recording, you're going to get a little pop-up. If you will click on that, that would be great. We still have some people coming in, but I think we can go ahead and get going. All right. So welcome to our monthly Ranch Right Ranching.FYI webinar. This week, Walter is not able to be with us. I was actually really hoping he was going to be here for this discussion, but I have recruited, because Robbie doesn't quite fit the age bracket as far as I can tell. I have recruited a number of seasoned citizens to talk to us about liquidity. And the reason I want to do that is because I want a little bit of a long-term perspective on this topic. There has been a lot of buzz in the last couple years about inflation rates and interest rates and things, sort of going on in the macro economy and how it affects our, personal and business financials and economics. There are a few things that I think Walter and I especially believe are bedrock principles that we don't want to stray from. And I think there is a lot of messaging in the world right now that might be leading people in a bad direction. So when I have discussions with people like Shannon Sims and I see him going down a bad path, I feel the need to really try to help him out. So anyway, today we have a new presenter, and that is Robbie Alexander. Robbie works for Farm Credit here in Wyoming. He was referred to us by Irv Bard, who a number of you have probably seen present with us before. Irv speaks very highly of him. Robbie, you work in the Young Farmer Rancher program with Farm Credit. Is that correct?
That is correct.
Excellent. Do you want to describe just a little of what you do with them?
So we have a special program to help our young farmers and ranchers get started in the ag industry with some reduced credit standards, some reduced collateral standards, and just giving them some different options that we normally wouldn't offer to everybody else. Everybody knows getting started in ranching and farming both can be difficult, even if you're coming from a generational operation that needs to change over time and move into the next levels. So we specialize in that by also not only giving them the loans, but giving them the opportunity to learn, expand, and spend a little extra time with them throughout each day.
Excellent. Very good. And then we have Wally has been a presenter here numerous times. As many of you know, Wally and I have been friends for a long time. Wally's been very kind to me, taken me under his wing and taught me all kinds of bad habits and good habits and things in between. We'll come back to Wally in a minute. And then Bob Metzger is here. Bob, you're still here, right? Yeah, there you are. Bob, do you want to give us just a quick introduction on your sort of the arc of your career? You've covered a number of interesting things here that are relevant.
Well, most of my work career, I was vice president investments with the investment firm A.G. Edwards. We were the fifth largest brokerage firm in the country, managed about $160 million customer assets. But I always had my fingers in the pie of agriculture and cattle. And so when Wells Fargo bought out A.G. Edwards, I decided I didn't want to work for Wells Fargo, and we've been running cattle ever since and enjoying every day of it.
And Bob, you have a neat perspective too, because you've also owned a number of other businesses, right? You owned a tax preparation business and a laundromat and a whole bunch of other stuff, right?
Well, we own a couple of dry cleaners, and they've been good. Yeah. And we own a tax preparation service. We were also area developer for the third largest tax prep company in the nation, and had 52 offices in Dallas, Fort Worth, and El Paso.
Important point. Bob is no lightweight in this area, so this is great. Now, some of the things that we're talking about is have a lot to do, in my mind, with business principles in general. They relate obviously to agriculture, which is where we all come from, but these are things that have a lot of, sort of interest and importance in other places too. So I want to make sure that we sort of have the discussion open to those things. So here's what I'd like to do. I have asked if Robbie would give a brief introduction on liquidity, and a term we often use associated with liquidity, which is working capital. Working capital is a financial metric that I know Farm Credit stays fairly, at least in this region, stays fairly focused on. Some banks have gone a little bit away from it, I believe, kind of at their own peril. But Robbie, if you would kind of introduce, what liquidity is, why it's important, and then we'll go on from there.
Okay, glad to do that. And so when I usually give these kind of conversations, they're young, beginning farmers, and we start out extremely basic and kind of go from there. But basic liquidity, it's the ability to meet current short-term obligations, bills that are coming up in the next year, current principal term payments off long-term debt, the fuel bill, the feed bill, the mineral bill, all those kind of things, the insurance, things that'll be up in the next 12 months to meet those debts without disturbing day-to-day operations is how we describe the liquidity. So the ability to meet current short-term obligations, 12 months without disturbing day-to-day operations. Working capital is another term that we will talk about a little bit, and that's current assets minus your current liabilities gives you your working capital. So if I'm going to try to share my screen real quick and kind of go from there, see if we can do that. And I'm going to go from here.
Very good. Look at this guy.
So this is a basic balance sheet without all the things on there. And all this stuff is really focusing on this top part of the balance sheet. So if you look at the bottom of the balance sheet, that's going to be your long-term assets, your long-term liabilities. And if you go back to the top of this balance sheet, this is how we handle day-to-day life. Now, you combine this with the cash flow that we highly recommend our young, beginning, and small operations to have. It kind of gives you a blueprint for the year. It kind of gives you an idea of what money's coming in and out and what's going there. So we highly lean on being liquid. If you're not liquid, money has to pull from somewhere. So we tell everybody, and combined with working capital, that working capital, your liquidity is your lifeboat for your operation. The more lifeboats you have, the more you can withstand. Now you can tell yourself, what kind of lifeboat do you want to be on? If you remember back a few years, there's this movie called The Titanic. And at the end of it, there's this couple in love, and all they were, and that girl was laying on a door. Both of them could have fit on it. But do you want your lifeboat to be that door with no food, no shelter, and you're getting cold up there, letting your partner freeze to death in the water? Or do you want a lifeboat that can get in there and sustain you for a little while? So, and this is what we call liquidity and working capital. They're pretty easy to figure and keep track of, but also with that working capital. As you see that number increase or decrease, if you can't meet those 12-month obligations, you've got to pull that money from someplace. And that's either getting an off-farm, off-ranch job or selling long-term assets, going back to your bottom of your balance sheet. Now, on the flip side of that, when things are working right, we start to say, all right, now we have built up working capital. What do we do with those funds? And that's where good conversations with your accountant, good conversations with people that understand the farm and ranching business, and good conversations with your lender really start to make a difference on, do we pay off extra debt? Do we not? Do we invest back into the operation? Do we pay down our line of credit? Do we want to pay off long-term debt right now or not? Those are all important conversations, because that'll start to feed the bottom side of this balance sheet. So that's one thing we start to talk about. How do you balance that? How do you balance building and building in the bottom side as well, but building that working capital that you can withstand anything that pops up? The blown tractor engine, the death loss that you didn't expect because your neighbor brought in BVD, and the things like that aren't normally out there. These are all situations I have dealt with in the past 2 weeks. So I don't know if that's hitting everything that you need. I'll get out of the way and
this is great, Robbie. Thank you. First, I just want to make a note that if you guys don't know, that Shannon Sims was actually on the Titanic. He was one of the men that jumped out first in a lifeboat and rode to shore. But he shows really well for his age, but that's what he did. That's how he's with us today. Anyway, continuing on, let's give a couple of quick definitions. Robbie, can you give us some examples of current assets and current liabilities? But let's focus on the asset side so we make sure we know what those are.
Absolutely. So current assets, that'll be cash, savings, things that you can put money on or make money immediately without disturbing the flow of the operation. So cash, savings, if you're, I would say a paycheck, but don't go past 60 days on that. Don't think, oh, I'm going to get paid X amount over the life of the year. Hay that you have in store, mineral, feed, things like that. Vet supplies are often missed on the balance sheet that a lot of ranchers have large investments in. And when we start to talk about those current assets, anything that will be converted into a useful crop within 12 months as well. Something that you're building up, fertilizer can be on that, and what you put in seed and things as well.
Very good. And then our short-term liabilities are notes that are basically due within a 12-month cycle, right? So your line of credit, as the perfect example, is a short-term liability. Your mortgage is not.
Correct. Credit cards, and we see that truly eat up those current liabilities.
Right. Yeah, very good. One thing I'm going to mention here in passing, we are going to come back to this in a future webinar, is very important that we match assets and liabilities of the right type to each other. I have been seeing a ton of long-term assets financed with short-term debt in the last 12 months, and it's breaking my heart because the mismatch between those is important. I'll just say that.
Yeah.
All right, Robbie, that's awesome. Wally, Bob, let's start with Wally, if that's right. Do you want to add anything to what Robbie said?
No, basically he covered it pretty well. One thing, if you're starting out, to me, the biggest misnomer in ranching is we do not create enough margin in this business. And if you just got to do that. I mean, we're we're used to I did a Google search of ag economics stalker programs of the United States, and there was only one of them that their budgets had profit in it. Of all the universities I could find, there was just one that had profit. And this coming from Bud, profit's just the cost of production, and you got to have it in there. And in this day and age, you've got to have a large margin, and and there is large margins out there. You just got to find them. But we settle for not a very high margin.
Very good. Bob, you want to add anything there?
No, I think that's been well covered.
Excellent. All right. So Robbie, excuse me, Robbie touched on this idea of liquidity as a buffer against risk. And we've talked about this in this forum a number of times. I want to go on a little with that. When we talk about liquidity, and again, Bob and Wally, I'd love your perspective on this, right? It's always the unexpected that gets us. When we do not have liquidity and the unexpected happens, that means we need to either, come up with an additional, what I'm going to call bad debt at that point that we're going to pile onto ourselves, or we cut into the meat, right? We start selling good stuff. We have to sell off part of the factory. So maybe Bob, I'll let you go first, if that's right. You want to talk a little about liquidity as it relates to risk? And I think the risks we want to, I want to be a little explicit with risks, because I think we see, market risk, production risk, environmental or weather type risk, production risks. We can just keep stacking those risks on in our industry.
Yeah, well, there are a lot of risks. You just went through many of them, and certainly you need a buffer against those risks. But equally, I believe you need a buffer to be able to take advantage of an exceptionally good opportunity when it arises as well.
Very good.
If you're on a line of credit and it's $1 million line of credit, and you're at 990,000, and you get a chance to buy 200 cows that are way below market, that you feel like have a lot of value, that'll give a great return on investment, that's a real poor time to start trying to go back to see your lender and with your hat in your hand and say, well, you know, I didn't really plan very well on this, but look at the opportunity I've got. So I think you have to plan for the potential of risk, obviously, and having a buffer against risk, but you also need to look at the potential of a good deal coming along. And without having some reserve there, you're going to wish you had sooner or later. Either way, whether it's risk or whether it's opportunity. I saw a deal one time that came out from the American funds, and I always get tickled at a lot of people I see going down the street, talking on their cell phone, smoking cigarettes and walking and wearing wife beater shirts. And a lot of them have Chinese characters that are tattooed on them. And I don't know if they're necessarily multilingual or not, or bilingual, but at any rate, I actually saw a deal from American funds one time that showed a Chinese character, and it said in the Chinese language, or with the pictographs, risk and opportunity were one and the same. It just depended upon how it was used. And so I think that could apply here as well, John.
I love it. And so when you catch Bob and he takes his shirt off, you're going to find that tattoo on his back, I guess. Is that what you're telling me?
Yeah, well, a lot of times people get carried away looking at me in my Speedo and they don't even notice the tattoo, John.
Again, Shannon has the same problem.
Yeah.
Wally, tell me, talk about risk and liquidity.
Well, you know, one thing is going back to with Bob is you know, we're so entrenched, and one thing, most of what I do came from Bud Williams, and Bud, you know, talked about the art of contrary. The only book he ever gave me was a book written in 1947, The Art of Contrary Thinking. And you know, everybody says, you know, you got to have your money working for you. Well, yes, you do, but also, you know, if you have a high margin business, you know, and you look at the rate of return on you know, most money, you know, is, you know, it's going up now, but it was, you know, 4, 5, 6%. And if you have something that, you know, does 25 or 30%, you know, that money can lay around for quite a while and not have to, you know, be performing. And in my business, when I got myself into trouble is when I thought I had to have every dollar working for me, and I didn't have the liquidity and the working capital there to take the glitch. And there was always a glitch coming along, you know. Same way with grazing. You get to pushing your grazing out there, and something's going to come along. You're going to stub your toe, and so, you know, having you know, grass and money is a great thing.
I think of this, Robbie. We'll go to you next, but I think of that sort of analogy you're making there, Wally, and the picture. And we have a concrete driveway in front of our house. It's got a bit of a pitch to it. And when our now 5-year-old was 3, she loved to run down that at full speed. And when it worked, it was awesome. But every now and then it did not work. And we were, you know, a skinned bloody mess from the forehead down to the toes. Every one of our kids has taken all of their toe skin off at one point or another on that driveway. And it is very unforgiving. And I'm afraid markets, weather, all kinds of other things are about as forgiving as our concrete sloped driveway. They just don't. There is not a lot of bounce there. You skid and you are the one that's going to lose the skin. There's not much that comes off the concrete. Robbie, you want to add anything to that? I'm sure you've got lots more specific examples.
You know, I would just say that, yes, we want our money working for us, and that's an easy thing to lean on and say. But you've got to think about the opportunity that the cash in your hand gives you. And I'd give my own personal experience on this. I graduated college, had some debt, and I went straight into the thinking that I just need to pay off debt. And I did. I got real serious about it, was able to get all my student loans and stuff paid off. But about 6 months after I wrote that last check to get things paid off, the farm next door to me come for sale. And I had no liquidity. I had no cash because I got real serious and I couldn't make the down payment. And I couldn't go back out and take a loan against my student debt because, I'd already paid that off. It was gone. And so I turned around, and instead of leaving 3% student debt on my books and just paying it as it goes, I missed the opportunity for a farm that would have appreciated greatly in the past 6 years. And then not only that, I had to save back for that down payment to buy the next one that come up at 6% money. So paying off that student debt that was going to be a 3% debt has cost me a lot in equity. And when you're getting started in agriculture and you're building a ranch, equity is your goal, in my opinion. So you got to think about how you use your money.
Very good. All right. So let's, with what you guys have talked about, Wally, you touched on this a little, inflation. As I mentioned at the top of this, we hear a lot about inflation. We hear a lot about interest rates. We hear all kinds of contrary messages about debt, right? You should be either all out of debt or you should be entirely in debt. You should have every dollar working for you, or you should, have some of it resting. Please. Who wants to start?
Well, to me, to me, it's the whole deal is about relationships, whether it's in marketing or borrowing money or whatever. It's relationships. I mean, and if you got something that's going to return 8% this day and age, and you go borrow the money, you aren't going to move forward very fast. But if you've got something that will do 30%, maybe you want to seriously think about leveraging it. Leverage to me is just a tool, is all it is. And you just use it wisely. I know a old rancher I grew up with, he said, you only borrow money on something you're willing to sell, though, to create the cash flow so you can pay the debt. I mean, if you're going to, so, that's my little window that I look at. So
very good. Bob, we visited a little earlier. In your mind, does the inflation rate impact your thinking about the importance of liquidity?
No. It doesn't matter to me whether inflation rate's negligible or if it's 6.3. What you need to be looking at is how you can make money with the asset that you have available, either a line of credit or if you're self-financed. Anytime you start trying to push a square peg through a round hole just because extraneous factors have changed, it's probably going to blow up on you, John.
Yep. Robbie, you want to add to that?
Yeah, I would always say that you need to have a good team of advisors to give you some stuff and understand your goals. So you don't want to have so much cash that it's hindering you laying around.
Right.
But
we're going to get to that next. Yeah, good. That's a good pivot. Keep going.
But I would also say we pay a lot of money in insurance that we don't gain anything on. And the things that you kind of lose in inflation, consider that an insurance cost on things that you just can't buy insurance on. Having that cash gives you security.
Oh, I see Shannon's mind burning. Go ahead, Bob.
John, I might just add, I think that's a great analogy you just gave.
Totally.
But I might just add that when I can draw 5% in the money market, and as opposed to paying 8.5% or whatever prime is at this point, it's a 3.5% net loss, all right, but it buys me the freedom to work a deal when it comes along, and that's really not going backwards all that bad.
No,
right. And just like Robbie says, just for the record, Robbie and I have never met before, and we've never actually talked about this topic other than for about a few minutes prior to this call. But the insurance analogy in my mind is a perfect one, right? I buy insurance for my car. I buy life insurance. I hope to never use them, right? I pay the premium happily each month because what I really don't want is indemnity. If I have wrecked my car, it means there's a problem. If my wife is cashing in my life insurance or I'm cashing in hers, there's probably some other issue going on. The $100 a month I pay for life insurance is a cost of doing business. It is money going out, right? It is an expense, etc. But it prevents disaster in a very bad situation, right? I don't need the death of my spouse and then to worry about how I'm going to support my family. This is a place where, and Bob, I'd love to go back. I don't know how much you can talk about some of your experience managing a fund, but when you're sitting on, hundreds of millions of dollars worth of assets, or even millions of dollars worth of assets, Bud used to always talk about the inventory triangle, right? Money is cash is a very important part of that. When you're sitting on assets that big, there has to be an incredible, and I know there are legal and other requirements, but an incredible responsibility to preserve liquidity.
Well, yes, no, but keep in mind, John, we were retail brokers, and we talked about having 1,200 accounts that encompassed $160 million. So everybody had their own set of criteria that they looked at, their own goals, their own risk tolerances, so forth and so on. So,
yep.
There's a lot of responsibility there, but at the same time, it was broken down in a micro rather than a macro.
Yeah, sure. But from a company standpoint, AG Edwards had its own problems, if you will, or sort of equations there too, right?
In what respect? You lost me on that.
Well, as a company managing other people's money, they would need to have, there are legal requirements there, are there not, for their liquidity?
Absolutely.
Okay. And those exist because sometimes things go badly, right?
Yes.
Okay. All right. Excellent. Anybody want to ask any questions about that? Anybody have thoughts on that? I want to go a slightly different direction here in a minute.
Okay.
I got a question about debt. I'm a little late to the call. Is now a good time to ask a question about debt, or should we save that later for later on?
Save it for just a minute. I want to go there in a minute. And I want to, so next I want to talk about, Robbie, you mentioned sitting on too much cash. I do want to talk about that. And then I want to go to debt after that. So did somebody else have something?
Yeah, John, I wanted to ask Bob a little bit more just to make sure that I'm clear what he was saying. When he says he doesn't care what inflation is doing, it's just been pounded into us that if we're not keeping up with inflation, our money's devaluing, which I understand to a certain extent. But what I heard Bob say is we need to have money on hand. And if we're earning 5% and inflation's at 6%, so be it. Did I understand that right?
You understood that exactly right. From my perspective, I would rather be going backwards 1% or 2% or 3%, waiting for a deal that might return me 25 or 30% than I would to try to force myself into something that was questionable or something that was marginal.
Right. And having easy access to that money, Bob, right? Like having that, like that cash that is ready for any opportunity to jump on. Like you would call that like a liquidity premium of sorts, right? Like
that's exactly
a bit extra more to have that money at your disposal.
That's exactly what I'd call it.
Okay.
Perfect. And that, if nobody else has any questions on that, that's the perfect pivot into where I want to go next, because Bob, when you say that, you aren't necessarily sitting on the sidelines with all of your money in a pile waiting for a good opportunity. You might be losing that 1%, as Shannon's asking about, on 25 or 30% of your total pile.
Your line of credit, or 20% of your investable cash, or whatever that might be. Yes. And
excellent.
I would stress that.
Yeah. Okay, great. So let's go on a little more about that. What is too much liquidity? Where, what does the other side of this look like? There are people that hoard cash, and that isn't necessarily good for their business either.
Well, to me, I think, 25% liquidity is a good place to be with good cash flow. You understand what I'm trying to say? Knowing that you may run that liquidity down on a deal, just like I've talked about. There's times I've been cleaning out couches and going through the pickup and stuff for cash and looking at my 6-year-old grandson's piggy bank, but there was cash coming. I knew I had it, and there's times when there's a good deal there, you run it down and pray, I guess. Like I said, I have in my past life, I have ran, without much liquidity and stuff, and it was, there was just glitches that came along, and you weren't able to handle them and stuff.
Robbie, you want to add to that? You brought up the topic.
I would just say you have to know your goals and what your risk tolerance is, where you're comfortable, and how you want to make your money. If you want to go get a W-2 job every day and you have a steady paycheck that is pretty secure, and you want to make your money, put it in a secure market account, something that will give you a return, maybe you don't need as much liquidity. But if you're entrepreneurial, if you're trying to expand and grow, you've got to know that goal and what it's going to cost to meet those goals in the future. And if you don't have your eye on that prize, your liquidity starts to get disappearing quickly, I guess you could say, and you start to spend it on stuff that doesn't advance where you want to go. New trucks are shiny. Loud pipes is when I talk to my young people, that's what I call the farmer mating call, and you're getting out there to get some more going. But those kind of investments, just because you have the money laying around, is not going to make you money. Consumer debt's not going to help. So you have to be disciplined with it and know your own habits.
Very good. Anybody have any questions, comments on that?
Well, one thing going back to Robbie, had to say, you need to understand that you can go buy those toys if you want to, I classify all those toys that you got the cash to do it. Just like my kids, we furnished them a car, but we didn't buy them a car, and they both knew that they wanted a car of their own, and they had to come up with the cash to buy their own car, and they both did and stuff. But you've got to have the cash, to go buy that stuff after you've replenished your inventory. Just like right now, there's lots of people that if they've sold their summer yearlings and haven't bought back yet, we've got a ton of money in the bank, and it's if you got $1.5 million in the bank, it's not that hard to go spend $70,000 or $80,000 or whatever on a new pickup, but you got to hold that inventory money so tight, and stuff. That's one reason why Bud always taught that you had to sell and buy back on the same market, and the reason is that we are so poor money managers. It didn't matter to him if you sold out and went on vacation or whatever, and then came back and just started again. That was fine. But we're so poor money managers that that's why he wanted to, so we'd hold our inventory money together.
So funny enough, Farm Credit actually did a webinar. I think it was early this summer, maybe in the spring, where they had a couple of guys on talking about sort of psychology of money and how people behave when they have $10 in the bank versus 100,000 in the bank, and they make very different decisions on a daily basis. It's kind of funny. It was an interesting webinar. Okay, so the other thing I want to touch on before we go back towards debt related to this is and I think this is important, oftentimes incredible opportunities come during disasters. I have got a little sister who is a saver. She, until about 5 years ago, drove the same Honda Civic that she bought herself in high school, which was like in the 90s. So to give you an idea, this girl is cheap and has every dollar she's ever made. She teaches school at a private boarding school. She and her husband and children live in school housing, right? So they have literally no expenses. This girl and her poor husband, like, their check goes in the savings account, never to be seen again. They eat at the dining hall. They don't spend any money. In 2008, when the housing market crashed, they began buying up beachfront houses with cash that were selling for, on the order of 30% of their value just a few years before. My school teacher sister, who probably makes, I don't know, for a long time, probably made about $30,000 a year, is sitting on $1 bajillion worth of beachfront real estate, right? So why is that? Because when there was crisis, she didn't have to go to the bank, right? She didn't have to talk to anybody. The opportunity was there. There was somebody that was in a real liquidity crisis, and she was able to help them out. And I think that one of the things we often neglect, especially when times are consistently good or consistently bad, is that when those big changes happen, institutions tend to freeze. Individuals with cash are incredibly mobile, and that is a huge advantage. So, Bob, I don't know if you want to talk more about that. You and I have talked about this a bunch before.
John,
Did we lose you?
Yeah, kind of.
There we go. He's back.
Well, you've covered it pretty much. I mean, that's enough said, but that's 100% correct. I agree totally.
When the market cratered, right, and people needed to get out of cows, boy, there's a great time to be standing around with a fistful of cash. Wally, do you want to add to that? I know you've seen some of those. What was you always use the example of that $600 cow you bought in Mississippi, or was it a $200 cow you bought in Mississippi?
No, I bought a $275 cow in Texas in the drought. And
there we go.
And 3.5 years later, I sold her for $3,500.
And you got 3 calves out of her in between?
Got 3 calves out of her. Just life was good, And to me, when you're in ranching, I'd love to discuss this. You've got to understand that you're basically, the world revolves around, and correct me if I'm wrong here, the world revolves around break even. And so right now, if you're and understanding how the market moves, the market moves 50% up, and 50%, when it corrects down, it will move about. That's what it does, And so if you look at the historics of 2014 and now, you basically need to be producing calves in the $165 range on a 500-pound calf. That is break even. I think South Dakota State says it's $864. I think is what it costs to run a cow now. And you can, you need to be able to be profitable at that level. And then when the 2012 and 13 and 14 and the 22 and 23 comes along, and 24 maybe, that's when you need to create great wealth, and stuff.
Love it. Robbie, you want to add to that?
I think that's.
Oh, sorry, Wally, you got more?
Well, go ahead. I got one other thing. Go ahead.
Okay.
But one thing you need to do is understand, there's great opportunities in the cattle business right now, but there's also great opportunities in correcting your present business. If you need, if you've got a bunch of cows that you calve in the winter that are too big and you want to get out of them, now is a good time to correct that. If you've got a bunch of machinery that you, in theory, don't need, this is a great time to get out of that, because people are going to be we got to manage our taxes. So now is a good time to sell stuff, in my humble opinion.
We have actually had that discussion a lot in relation to some of our Canadian customers who are experiencing terrible drought, right? And they are having to make some very difficult decisions. But man, what a market to have to sell a cull cow, right? What a great market to have to get out of equipment, just like you say. I mean, tractors are worth big money. Cull cows are worth big money. Like, great time to do it. If you have to be in a crisis, this is sure there are a lot of things helping us right now. Awesome. Robbie, did you want to add something to that too?
No, I think that covered it.
Okay, fantastic. Okay, so I want to change gears just a little bit, because Eric, you brought up debt, and this is one, and a number, you and Bob, you and Wally and Robbie have all kind of touched on this. I want to think about some debt in a relative sense. And when we talk about working capital, following the model of, I'm going to totally forget his name right here. David Cole, excuse me. He talks about having a portion of your working capital as cash. And I talk with a lot of people about that. I always want to have my own cash. Now, there are people like Shannon Sims who say, but wait a minute, why would I have my own cash and use somebody else's money and have to pay interest? And there are some good reasons for that. And again, Robbie, you mentioned the example of, getting out of debt, which is a quote unquote good thing, but then that causing you a personal liquidity crisis there. So do you want to expand on that a little bit?
To what point? I guess I would.
Well, towards how we manage debt, how we manage short-term liabilities, and how we manage cash, I think is probably important.
Yeah, especially right now, I tell anybody I can, my greatest day as a lender is the day that you don't have to come talk to me anymore. That means we've been successful and you're winning the game. So when it comes to that, yeah, you can have an operating loan and operate off that and take your cash somewhere else, but you got to be sure your cash is making the same amount of money to offset that. An operating loan today, I've heard as high as some places going 10%, as low as 7%. That's a pretty good investment right there. And is the cash that you're making or investing making more than that? And if not, why are you investing? Why are you not taking down and leaving your liquidity exactly where it could be and building those cash reserves?
Very good. Bob, do you want to add on to that?
I know I will.
Maybe we lost Bob. Okay, go ahead. Like I said, I'm real big in understanding, the relationships or whatever you're doing. When Robbie had 3% money, fixed, something, you knew something was going to happen, because interest rates just usually aren't that low, and granted, interest rates have been low for a long time, but you could feel the relationships of that debt was good, to other stuff, and the same way with in the cows, when your cows, you can buy a cow for less than it costs to produce her, something is probably going to correct, and she is a good buy. And so you may want to leverage her and stuff. And to me, like I said, you only borrow money on stuff you're willing to sell. I will go to my grave on that. If you're willing to sell it, or it generates income, you understand what I'm saying? If you buy a pickup and a trailer and you haul cattle and it's creating cash flow for you. Now that's different than just owning a pickup and a trailer, just because
we need to own a pickup and a trailer. You know, you could, you know, my deal is you can go rent lots of stuff a lot less, you know, and
Love it. Bob, you there?
Yes, I'm here.
Very good. Keep some of your own cash. What are your thoughts?
I don't think it's a bad idea. That's what I try to do. That's what I've always done.
Tell us why.
Wally described it perfectly. I think once again, opportunity, diversification also.
You know, the other thing I would tell you as you're looking at that, you got to think what is normal and what's not. Interest rates have been low for a long time, but that's not normal. You know,
Right.
we're at 6% now, and you talk to some of the other people on this call, and they probably made their first ranch farm cattle loans being at 16, pushing 20%. And maybe that's not normal, but it's a possibility. You know, I've seen a lot of people go back with that 3% money that was out there and pay it off quick, pay it off fast, and pay it off early, give up that liquidity, and now turn around and paying 9% on those operating loans when they could have kept that cash. And at the same time, now I'm seeing people advertise you can take cash and put it in a CD that can be drawn out anytime, no penalty, pushing 4.5%, 5%. You'd been better off and making more money by hanging on to it and have the same liquidity and keeping those other loans almost interest free. If you could have held on a little bit.
Yep. Very good. Eric, does that get at the topic you were bringing up?
Sort of, not really. But I'd just be interested in people's thoughts on, you know, this concept that I've come across the last few months. It's an old saying, it's an old concept, but I've just kind of stumbled upon it the last little bit. And it goes something like, if you're going to be in debt with your banker in a big way, like make it big enough that your banker is not your lender, they are your partner. And I'm like, wow, I like that, but it almost sounds too good to be true. I find it hard to believe that there's a banker out there that will never that will abandon their identity as a lender. Is that a thing? Like, have people been in a position like that before, where the fates of the two parties are tied? Like, in other words, like you're too big to fail, and so the bank has to stick with you.
I think you're operating on a false pretense there, my friend.
Right. So then so this is just a pure lie that's been spread around? I mean, like, did this used to happen? Like, where's this coming from?
I know. Well, I know. You know, Montford's that built Montford Packing and fed gobs of cattle in Greeley, Colorado and stuff, you know. He talked about how, you know, basically he was so much in debt. You understand what I'm trying? He was too big to fail. Well, he didn't exactly fail, but you know, the Montfords aren't in the Montford feed yards. And
they don't
stuff.
do that anymore.
They don't do that anymore. And there was probably some pretty good debt write down in there and stuff, you know. And you know, back you know, through the 80s and the egg crisis, you know, I did not know of anybody that was too big to fail, and I mean to tell you what, there was a lot of banks that you know went out and stuff, and you know,
I think if you're GE, there may be a point where this is possible, or GM, but I think if you're Eric Mose or John Haskell, it's probably not. Probably not in the cards.
You're too hard on us, John. We're not GM, but we're in the same cohort. We're up there.
One thing, and
I think that
go ahead.
Robbie would have an interesting perspective on this.
Yeah.
Yes.
Robbie, our officer used to be Jim Palm, and he's doing exactly what Eric is talking about right now. He's working with those businesses that are on the edge. You know, are you comfortable delving into that, kind of how you guys look at that?
Yeah. So Jim does it on the opposite end. Jim does it on people working in the edge that may need to consider transitioning out. I do it on the front side, working with the young and beginning that are trying to transition in, and both of our groups that we work with are pretty similar. So Eric, I would challenge you to say if you do find a lender that is you're showing up and just it's a yes, and we're just lending you money and not doing a business relationship with that and diving into your finances with you, you need to find a different lender. And I'm not saying that's a Farm Credit, that's a bank. I'm saying that no matter who it is, because they need to sit down with you every year, look at that balance sheet and say, this is where you're gaining, this is where you're not, what's your goals, and help you make those business decisions. Because all lenders should approach with, we're in business together. Now, your accounts may not be as big as somebody else's, but often out here in rural America, none of us are going to be too big to fail. Because if you're getting to the point we don't cut off your relationship, you start to affect what we can do from a regulatory relationship with other people in the industry, other people in the community, and ties have to be cut at some point. But if you're not having those conversations often and early, I mean, once a year, and you just hit a surprise on that, you got to question who you're doing business with. At the same time, a bank is asking, why should we do business with you? You need to be asking, why do you need to do business with that lender? And don't just take it somebody saying yes. I'm a big believer. A good no is much better than a bad yes for your operation.
Yeah, no, that's a good point, Robbie. And that's probably the reason why I'm interested in this concept, is because it's really hitting home on like the relationship. Like that's one thing that my business is missing right now, is we do not have a relationship with a financial lender. I mean, we work with Farm Credit Canada, and I just call them up and they'll just give us money, which is great short term, but long term it makes me nervous, because like you don't want to, all they care about is seeing my personal net worth statement. Like they're not looking at pro formas, they don't care about projections. They don't care about the business plan. Like, I got a pitch. Don't you want to hear my pitch? No, they just want to know the basics. And I don't like that. And we're trying to figure out a way to actually develop a relationship, because that's another way I view debt, right? Debt's a tool to further financial capital, but I think it's also a good tool to further social capital. Like, it's a great way to build trust long term, possibly multi-generational. Right.
You know, it's funny you say multi-generation. Just yesterday, I was out at the ranch. I was sitting there with two different generations looking at a transition plan, and the younger generation was asking for, let's just call it, I can't give out actual numbers, but let's just say $40,000. And the scope of this size of this operation is pennies. And I don't give out $10,000 without looking at a cash flow, a business plan, and a projection, 3 years taxes, and that you show me you have a solid plan to have that. And I would challenge you, go to lenders and ask them their philosophies, ask them what's out there. They're business partners for you just as well. If you're building a business, ask them to spend the time with you, see what they have to offer. If they're not doing those things and you don't feel comfortable, yeah, you might go somewhere else and it costs you an extra %, but what's that extra % worth for your knowledge, for your peace of mind? We get wrapped up in interest rates, and interest rates are something you have to consider, but it's like buying vehicles. Do you buy the cheapest vehicle that you have to rely on to haul live cattle down the road? Probably not. So know what's out there, know what you're buying for your money. Interest rate is a lot more than what you borrow money for. Interest rate is also your payment to get a service that you deal with.
So as an add-on to this discussion, we did, the person that introduced Robbie and I also works for Farm Credit here in Wyoming, Irv Bard, and on ranching.fyi on our podcast there and on the webinar, we did a couple of interviews with Irv, and we talked exactly that. I believe the title of the podcast, Eric, is along the lines of, banking with relationships or something like that. He talks a lot about that. And I think we also had done a really fun interview with a guy from First National. What's Marlon's last name, Wally? I can't think of it. Anyway, same thing. You know, he's a guy, he just retired literally within the last 2 weeks, you know, was a banker during the 80s, that sort of thing. And they said exactly what you're saying, Robbie, which is, Eric, it's not that we're forcing the too big to fail thing as though we are GE or GM, but we are building those relationships so that our, you know, and working with a banker who, you know, just like our attorney or accountant of these other professionals that we bring in, become a partner in our business and help us make the best possible decision, right? We lean on them as a resource for more than just a source of capital. They become a trusted advisor within our circle. And I think that's a very important thing.
Yeah, what I like the most about that, and I'm going to use that in an email this week, I think, is when I'm shopping around looking for like a member of our financial team, like a lender. It's going to be like, look, I recognize that the interest rate is more about than just the time value of money. There's a component of this that is the service. Please tell me what service you're going to provide. And that's really going to put them on the horns of a dilemma. That's a really good way of screening your lenders. So thank you, Robbie. That was good.
Cool. All right. Any other questions on that? We've got one more topic I want to get into just a little, if there are none. Wally, you touched on margins and profitability. I'd love the three of you to just talk about, okay, if our working capital either isn't where we want it to be, or if we want to maintain it, if it's good, you know, profitability, it sounds so silly, but in my mind, profitability in the business is what drives that. If you are consistently not profitable or profitable at a substandard level, it is hard to maintain working capital. Conversely, when you have working capital, it can make it hard to be profitable, and yet the way out of that hole is profitability. So, Wally, do you want to expand a little on what you said earlier, and maybe we'll go around?
One thing is you know, ranching for profit, you know, talks about 10% opportunity costs, you know, on what you're doing, and I, you know, did that, but you know, if you use that factor, I promise you, all you're ever going to make is 10%, you know. And so I got to ramping that up there, and one number I use right now is 25%, and it depends on, you know, time and, you know, stuff, and how much time I'm going to be using, or, you know, the deal is, but you know, ramp it up to 25%, and then start, you know, if you can't find something, then go down to, you know, 25, 24, you know, it's just like an auction, just keep going down until you find something. But I promise you'll be way above 10%. You know? And,
Wally, just to clarify, you're talking in terms of 25% annualized, not necessarily 25% on each individual.
Some of them are each deal.
Well, every now and then we find an acorn, don't we?
Yeah, every now and then you and I find an acorn together, yes, and stuff. But I'm, you know,
but not every acorn grows into a full-size tree, right? So there are plenty of these. We start with a 25% target that there's a few hiccups and it doesn't quite hit the mark.
I've actually been impacted on acorns before, so got to be.
Every now and then somebody comes and makes a pie.
You know, you need to understand, you know, like everything else, you know, who you are and what you can handle. But you know, if it's, to me, it's amazing how much more margin you can get in this business if you just learn how to do it and stuff, and things. And you know, one thing that I really like about sell by marketing over how everything else is done is you know, and I think Excel and all these programs have just done a great disservice to us, is that, you know, And like I said, most of these programs come out of university, and I only found one out of about 15 universities in stocker budgets that had profit in there. And so, you have to look within the deal. I mean, if you buy calves this time of year weighing 400 pounds and run them to into September and stuff or whatever, and they weigh 800 pounds. Well, you will probably, if you look within that deal, you could turn that inventory over sometime and double your turnover and probably double your margin, because the first 300 pounds you put on them probably made you all the money, and the next 200 pounds, I should say, and then the next 200 pounds lost you money or didn't make you anything, and you need to be aware of that. But we're so used to doing our projections, and I hope I'm not getting on anybody here, but you need to, be looking, you need to look at your inventory value almost daily and say, well, we need to swap these things out. And
Yep, very good.
Go on down the road.
I got to jump in here for just a second. I got to say two things. It's an impossible situation because 90% of the people that come through the school say that 10% is too damn high. There's no way you're going to get that. And then we got Wally coming at us saying it's too damn low. You guys need to build some profitability in these businesses. So I feel like it's a pretty sweet spot. But I just want to point out that 10% is not profit. That's the opportunity interest on the cash. That's what your cash could be doing for you if you just left it in a good investment vehicle. And I think that ties back to what Robbie was talking about earlier with how much cash we have on hand. If we have cash on hand, it can't just be sitting there. If we're lending ourselves money, are we paying ourselves a fair interest? So, as an instructor, I've got to make sure that I can look Dallas in the eye. So I got to point out that that's not profit. Profit is on the other end.
But profit will often sink to that level. How does that sound?
And that I won't disagree with that. We see it all the time.
Yeah, if you look higher, you will often shoot higher. Yep. Very good. Bob, you want to add anything to that? I'm going to put Robbie in a pickle here for just a minute after that.
No, I'm in good shape.
Good. We'll get on.
Let's see how pickled Robbie can get.
Okay, so Robbie, when you have a customer that has bad working capital, and we may define that the same way, we may define it differently. Our target for our customers is, in the 120, 150 day range, sort of a la David Cole. When you've got somebody that's bad working capital, either it's, 7 days or it's negative or it's, 30 days, what do you do? And I'd like Wally and Bob to chime in on this too, but if it's all right, you're the new guy, so I'm going to pick on you first.
All right. That's the golden question.
I agree.
And we're kind of in a time frame now that we've taken away some of our tools, and I'll explain some of that. One, we used to go back and say, let's refinance. Well, a lot of people that's been in a bad shape for a little while now, we've refinanced at 3% money and spread it back out over 30 years. Well, if you're at 7 and 8% money now, you can refinance and your payment's going up. That's not helping your working capital. So now we're in a weird spot. That's no longer a tool in our tool belt that we use for the past 20 years. The other thing is you have to start looking at what you can get rid of. And unfortunately, we're getting rid of the factory. You sell out part of the herd to pay the bill. You're not helping yourself. You're just slowly delaying the inedible. You're better off to go ahead and sell it all and re-examine, especially when we're in the markets we are today. And you got to ask where you're at in your operation. Do you have any equity that you can leverage to refinance? If you don't have that, if you've started out and you've borrowed to that point where you only have 30% equity in entire operation, you're out of options, really. So your option is to sell. And that's why I'll tell you, building that cash, building that liquidity, building that working capital helps with that. But if you're there where you don't have it, when you see down cycles in our business, when we see down cycles, we start to say that's what calls out the people that weren't truly making money. And you got to know if you're one of the people that needed to be called out. And you got to be real honest with yourself when we get to that point.
Yep. Very good. Bob, you want to add anything to that?
No, I think he covered it very well.
One thing,
Wally?
well, go ahead.
No, go ahead.
One thing I will add to that is you know, with the crash in 2014, you know, there should have been, you know, that was a terrible crash, and there should have been more people that went out, but very few people went out, and the reason is just what Robbie was talking about. We were able to refinance land
Yep.
at a very low interest rate, and
there was equity.
And there was, there was equity, you know, and this time around, you know, when it goes south, you know, at, you know, 10 or whatever % interest it's going to be, you know, and also they're still carrying the debt that they picked up in 2014, you know, and like I said, this isn't going to be quite as easy, you know, and just like, you know, going through the 80s, you know, Lordy, that was a learning experience and stuff. And also you got to understand that being broke, you know, like an old rancher I grew up with, he said, you know, one thing nice about being broke, you know exactly where you're at financially. And, you know, Mr. Burtis, you know, we'll just start over, you know, and, you know, depending on what you want to do, you know, you're starting over at a different level. Hopefully you've learned something through this, you know, and things, you know, when I started in 1976 and we bought our ranch and stuff, you know, interest rates were 5%, and, you know, you know, everything had been wonderful for 30 years. I mean, you know, and we've had, you know, and came through the grain embargoes and stuff of, you know, of 73, where, I mean, you know, there was more old 73 bobtail trucks on farms. I mean, tell you what, everybody had money, and, you know, and, you know, and it rolled along, you know, my operation was, you know, basically 100% leveraged. I mean, you know, and down at 6% interest, we operated very well, you know, but when that interest rate went to 18, and then land value started cratering, needless to say, you know, it wasn't a pretty sight, and not everybody got through it. Not all the marriages got through it. Not all the people got through it. And I hope it isn't that way this time, you know. And I'll go back to Robbie, you know, no sometimes can be the greatest thing a lender ever tells you. I mean,
is it all right if I jump in here for a minute?
Please.
Okay, Wally seemed like he just described my business where we're sitting right now. So we've been operating at trying to scale for years, and finally this is kind of year one of us being at a reasonable, we feel like we're real farmers and ranchers type of scale. We're not just a little peanut operation, we're actually ranching now. But year one, things are going good, but they kind of have to be to get our working capital. Like, we've always been so tight in cash flow that we never, you know, we had nickel and dime on everything. Now I feel like, okay, we have some cash, we can, you know, make the payments and make stuff happen, but we've got to keep doing that year over year. And, you know, we're looking at expanding and we're looking at growing our operation, but we're also looking at, you know, a little bit higher interest rates. Land values and equipment values are astronomically high. And contrary to Western Canada, like where we're at, we're sitting on a pile of feed. and looking at high cow values. Should we be expanding right now? I know it comes back to the relationships, which I haven't had a chance to look at for our operation for this fall. And we're definitely looking at, you know, okay, what we got to focus on the price relationships and on the cattle side. I guess, what other advice would you guys have for an operation like us that's looking at expanding and growing in the environment we're at right now?
Do you have any market risk protection there?
As like price insurance on the cattle side?
Yep.
Yes.
Because you know, now all true sell-by marketers that slap my hands and say I'm talking heresy here and stuff. But with that said, you know, for you know, $75 a head now, I can lock in. I can't tell you exactly what the you know, price is for next August. You know, I can lock in, you know, close to $2 or $2.80 or something, you know, price with the LRP. And just a second, let me work through this. So that is $8.80 a hundredweight and insurance that I'm buying. I'm leaving the top end open, you know, and last time I looked, there was like you know, 450 or something dollars in this deal, you know, that we're looking at. And so for you know, instead of getting, you know, $280 for these cattle, we're going to, you know, get $2.72. Plus, we are protecting the quantum leap in inventory value that we have just experienced. And
because you're protecting the bottom if it falls out, but you still have options, like you can still capitalize if it goes up.
Yep, the top end's open for $8.82 a hundredweight. So you just, you know, it's just a business decision, in my humble opinion. And you know, I'm 72 years old, and you know, I'm willing to do that. You know.
And is this something that you do on your entire calf crop or livestock inventory, or a
Well,
portion of it?
This is done on just stocker cattle that we were running and stuff. And I would seriously look at, if I had cows, I would, to me, if the insurance cost isn't too high, you know, I believe in self-insuring as much as I can, but I also believe in looking at where we're at, you know. And 2 years ago, I you know, wasn't too excited about using the LRP. I mean, because the risk wasn't there. And now, you know, anytime you have a market go up 50%, I promise you that if we are not at the high, we're a lot closer than, you know, we've been before. And so I'm just willing to do it and go do another deal, you know.
I got two
comments.
Oh, sorry, go ahead, Brett.
This would be similar but slightly different than on the grain side of our operation, where we're forward contracting our commodities, right? Like, because there we're actually selling it, locking in a price for a future sale, but doing a portion of our crop in that, okay, we know we've got this price on 25% of our wheat crop.
Yeah.
And the rest of it, we can, you know, it might go lower, but if it goes higher, we're still in the market for some of it. Because there you're locking in the upside and downside potential. You're committed to it. Versus with the, you guys call LRP program, you're preventing the downside, but you're still open to some upside.
That's correct. We're open to all the upside, which you know, to me, I'm you know, granted it could go up, you know, if it, you know, like I said in the cattle business, if it rains and just on and on and on, this thing could get really wild, you know. But you know, we've got most of the gravy out of this run, and just need to, you know, to me, you just need to be protecting yourself if it's reasonable. I mean, you know, and you know, to me, like you know, I will squawk, and, you know, my LRP agent, I just love griping at him, you know, that, you know, he's building a new house, and you know, and on and on and on, you know. I don't need to be paying for it all in, you know, 1 year, but
Just remember, Brett, for some people in agriculture, complaining is kind of a hobby.
So the thing with
Or
LPI or LRP, like in Canada we call it LPI, you know, in our system up here in Canada is a much more simplified version of LRP, is that it's a hedging deal, but like basis comes into a factor. Like so right now I'm in BC, so it's not a perfect hedge because I'm not in the same market that the index is based on, right? In Canada, there's two indices. There's the Alberta, and then there's Saskatchewan, Manitoba. And so there's a bit of a basis there. So that kind of convolutes the hedge. And then also your weight, right? So there's feeder class and calf class, and calf class is based off of your 600-pound fancy steer going to a Southern Alberta sale barn. All right, so I can still hedge, like but it's not going to be a perfect hedge. The only way it's going to be a perfect hedge is if I'm located down the road from that sale barn in Southern Ontario. So or Southern Alberta. So just keep that in mind. And then but the second thing, though, I just thought of bringing it back to the conversation of liquidity, is that because you are hedging against risk. I never thought about this until now. Let's say you have a rough 50% hedge, then theoretically you can release 50% of your cash reserves and maybe lock that up somewhere into a higher interest vehicle. You know what I mean? So I've never looked at LRP or LPI through the lens of liquidity, right? Because that's why we have cash reserves, is to protect against risk, or one of the reasons. But if I'm doing that through a different method, through hedging, then I don't have to carry such high cash reserves, and then I can lock it into you know, a long-term instrument of some kind. Am I out to left field on that, John? What do you think about that?
I think that depends then on the vehicle you are using as your insurance policy, because if it is a real hedge through Chicago, then you might need to increase your cash reserves.
Right. Yeah. When I'm talking about hedging, I'm talking about using
the LPI. Yeah.
Not like not a Chicago Merc hedge.
Right. But that's a good point, and that's actually Bud, Wally, you want to maybe expand on this? I mean, Bud used to talk about that very specifically, right? Like you've laid these off, you've contracted them, and whether that's a futures contract or a board contract or different things, you know, that is an opportunity. Now those cattle are effectively sold. Now there are still some variables in play.
But the thing I like about, you know, when you're, you know, the one thing I do not like about hedging and forward contracting is with forward contracting, you locked yourself in a box. You have established the time that you are going to deliver those cattle, and there's a lot of things that can happen in that time, you know, that you know, you get in a drought, you know, this, that, and everything else, you know, and with hedging, you know, back in 2014, Wallace Olson, the super marketer that he is, knew that feeder cattle could not go over 175. And needless to say, when we hit 241 for them suckers, that was $410 a head margin calls and them sweethearts, you know. Fortunately, I only had one load hedged, you know, and stuff. And one thing, if you're truly into sell buying and with rapid turnover, that takes care of your market risk, because you know, if your feeder cattle go down $20, I promise you the calves are going to go down probably more than $20, you know. So, but if you've got the equity and stuff to stay in the market, you know, you don't have to dwell on any of this stuff. It depends on who you are and what you're going to do. But if you are, if you only run one set of cattle a year and some things, you need to do it differently. If you turn them over 5 or 6 times a year, that's different.
And if you're heavily leveraged.
And if you're heavily leveraged, yeah.
And again, Brett, people in your situation, we have a number of people in that situation, right? You're relatively new in the business. There's that, I don't care if you're an infant or a doe or a young business, whatever it is, you are very vulnerable at the first part. And if the tiny bit of equity you have goes backwards, it can be fatal very quickly. And
well, I guess
go ahead.
The other thing I'm wondering about here, especially in this liquidity talk, and you're talking about having some working capital set out in front of you. Where's the balance between how much working cap or how much liquidity you have in front of you and how much like expansion or improvement you make? Like I've got a wish list of things I want a mile long, same as I'm sure everybody else. One of those things on that list though is to have a good cushion in front of us. But like you and I talked, another one is a new air drill. They're very expensive, but they also provide a lot of value to our business. Where do you prioritize, what comes first at what level?
Dang, Brett, it's too bad you don't have an EL board to help you work through this.
This guy, who invited you?
Well, that's still better advice than
Well,
I was going to give, Brad. I was just going to say you just roll the dice, so.
Yeah, heads you do it, tails you don't, right? That's how we make all these
Flip a coin.
Look,
It's kind of like you run your ships aground and you just fight your way out so you come home on the enemy ships. It's that deal.
Maybe.
I would, and I can tell you what I tell a lot of my growing producers, because you do get that list a mile long. And I've also found when about 10 to 15 years before the operation is turned over, Dad and Grandpa quit investing in some of the things, and the list is a must need. You have to make a priority list, and you have to know how much it's worth to you in the opportunity cost, what it could be, what it couldn't be, and how that's going to affect you long run. And I would also go back and say, what can you patch up? What can you get by? What can you rent? What other avenues can you get out there that you didn't know, that when capital goes on sale and you are sitting there with liquidity, you can take advantage of? And yeah, it may take down your liquidity then, but if you've got that $100,000 drill and you bought it on sale for $70,000, that makes a huge difference, even if you had to spend a little bit of money on rent a couple other years. Priorities. Yeah.
That's been our mode of operations up until now. Yeah. So you're saying is when in doubt, lean on having some reserves before you go in investing.
Absolutely. And if you do that and you do have to go out and invest in something else, what can you do to take away some other volatile factors? We all get caught up and we hear about these high dollar cattle and we hear about what's out there and we think we're going to go out and run out and hit a home run every single year. Quit trying to hit them. Get on first base, especially when you're in a growing operation. If you can hedge them, if you can forward contract them or do something, yeah, you might miss a little bit of upside on that, but you got that payment made. It's going to build some equity in a piece of equipment. It's going to build some equity in some real estate or whatever you had to purchase. And that's just going to be the cost of doing business. Home runs can happen.
I couldn't agree more. I think that's a great point.
So, Bob, I want to follow that up. How many miles are on your Camry?
Well, nearly 451,000 now.
Broke 450 the other day on a what year Camry?
05, but I bought it from Wally Olson.
I was going to say you bought it from Doris Olson for how much?
4,500.
Okay. Now, Bob Metzger won't tell you this, but he probably could buy a truck if he wanted to. And I've
got a truck.
You got
I've got
what
a
year's the truck?
F350 with 483,000 miles on it. But you know what, Robbie, you made a very interesting point just a moment ago, and Peter Lynch was probably one of the best mutual fund managers that ever lived. He ran the Fidelity Magellan Fund for 17 years and just had outsized returns that were unbelievable. But he had a saying that I repeat frequently, and it applies to us right now in the cattle market. He said, "Don't ever confuse brains with a bull market."
That's right.
And anytime we've got the opportunity that we have today to lock in outsized profits, we need to look at doing it.
And then put that money somewhere where it continues to work for you.
Yes, sir. Absolutely.
Right. Not into stuff that works against you.
Absolutely. That depreciates.
Yep. Okay. So let me add a few things to this. One of the reasons why we work with people and their financials has a lot to do with the outsized impact that financials have on people's lives, right? We see case over and over again where financials impact marriages, right? Financials impact relationships. Financials impact people's personal feelings of well-being. There is something that happens when working capital is low. And one of the main things is a sense of fatigue, burnout, whatever you want to call it. And I find, Robbie, I asked you this question. I told you I was going to put you in a pickle there about getting out of a bad working capital situation. What often happens, whether you're a new producer or an older producer with a working capital problem, is you are fighting, you're sort of working too hard, right? You're suffering through difficult situations. You are living with chronic stress. When we have problems with long-term debt, often we pay that debt annually, right? So the stress is kind of like 60 to 90 days of the year. We're worried about it, but it's not presenting itself to us every day. When we work with a customer that has bad working capital, they are not sleeping well every night. Right. And that takes a tremendous toll. It takes a huge toll on relationships, takes a huge toll on well-being. Wally, we have talked in the past about it. It affects your ability to be a good decision maker. That is a level of stress that I hate to see people in. And it is so easy with a credit card to alleviate that stress in the short term and compound it into the future. And I think anytime we can not do that, or we can do the opposite, we are better off. One of the things when we are talking about getting out of a working capital problem, I think that is the point where we need to be as courageous as we can possibly be. We need to make decisions there that are going to be painful. Sometimes we can do it by simply being, focusing on being more profitable and dig ourselves out in a fairly straightforward way. But sometimes it does require cutting some meat away so that we can survive in the short term and go on. Wally, when you describe your situation in Kansas, in the 80s, that's when you discovered you weren't too big to fail, right? And you learned a whole bunch of specific lessons there that were going to help you in the future. If we are willing to if we are in a bad situation with working capital and we are willing to take the hit and sort of do the work that is needed, it will be painful in the short term, but it often will provide fantastic relief in the long term. Bob, you driving your 451,000-mile Camry, right? I'm sure there are days when that is not the most convenient car to drive, but it is not pushing any responsibility for today's comfort into the future. So I hate to push people too hard on this in this situation, because again, if you are short of working capital, you are tired, right? This wears on you constantly. And yet that is exactly the point when you sort of need to grab yourself by the guts and make some of the most courageous decisions you need to make. Is that reasonably fair?
Yes.
And one thing to understand that going broke, it was a very humbling situation, but I can honestly say that going broke right now was probably one of the best things that ever happened to me. I mean, I'll be right honest with you. If I hadn't went broke, I'd still be probably up there, fiddling around in Oldsburg, Kansas, barely getting by, so, and just like I said, there's, one reason why there's all the bankruptcy rules and stuff in the world, you aren't the only one that's ever went broke. And understand, for God's sakes, I hope this is right, but understand that if you start over again, you're starting at a different level, and stuff. Now, if you do it again, just like Mr. Burtis said, you ask him how many times you've been broke. He said, well, the bank only knew about it once, and stuff. So,
But a very important part of that, Wally, is when you are in those terrible situations and you are, whether you're extracting yourself from it or working out of it or whatever, you need to have sort of the emotional and intellectual sort of fortitude to absorb the lessons.
That's right.
Right.
Mm-hmm.
And the lesson is not that the world is unfair and that everything worked against you. And if only it had rained, right? The lessons are 100% accountability of the person in charge, right? And the decisions that were made. And I see too many people have these difficult situations, and sometimes they get out of them, but they don't get the lesson. Yep. And the sad part is surviving through that deal in one way or another is not as valuable as the lesson oftentimes.
I know, just like for myself, the gentleman was talking about his want list. You understand what I'm trying to say?
Yep.
Just wad that damn thing up and throw it away. And, just, we think like I said, here I put animals out with people and stuff, and I see Triggs on here. I've never been to Triggs' place yet, but most of the people that I work with, when I'm talking to them about different things, they're usually on their way to town to either fix a flat tire, buy a hydraulic hose or something, or the skid loader through its tracks. You understand what I'm saying? We've got too much stuff. All you need to be in the cow business is a cow, and that's it. And the further you get away from that cow, the less profitable you're going to be. And with that said, I'm going to say one story that Mr. Burtis, he helped start the Quarter Horse Association, and he would go inspect horses and judge horse shows. He was gone quite a bit, and you'd have some great idea how to spend some of Mr. Burtis's money, and he'd say, well, yeah, Wally, that's a wonderful idea. He said, I'm going here and here and here and here, and I'll be back here in a week or 2 weeks. He said, yeah, we'll visit about it when you get back. So here comes Mr. Burtis back, and you're all excited about spending some of his money. And Mr. Burtis would say, well, how'd you get along? Well, heck, we got along fine, And then you bring up whatever you were going to spend his money on. He said, I tell you what, why don't we try to get along fine for a couple more weeks and we'll revisit this, and it never got revisited. We just got by,
The strategy my wife loves the most, I'll just tell you.
Yeah. And I guess now I have turned into Mr. Burtis. So we'll just get by, and stuff.
There's a great book to read by Dr. Gordon Hazard. He was a vet down in Mississippi that talks about that exact situation. And I had the fortunate events of visiting his operation many times. And you didn't see cab tractors, you didn't see bush hogs, you didn't see clippers, you didn't see people or hay equipment. He fought all his hay, he paid somebody to put it out, and he paid somebody to clip all his pastures. And never once did he had to stop and repair a hydraulic hose. He'd drive by and wave at them.
That old man saved my butt many times, knowing.
All right, Brett, you're making me realize we need to have a farmer on these deals periodically too.
I was just coming in hot.
I don't want you to feel picked on.
Not that I disagree with what was just said. I think there's some valid points there, but to be devil's advocate, I'm a ranching for profit graduate, and I've been to the school multiple times, and I've heard, get your overheads down, get your overheads down, get your overheads down. So I came home and we worked at getting our overheads down, and we did good things there. Increased our gross margin, got our overheads down. Problem is, our business had a turnover problem. We were just flat not big enough. It didn't matter how small the overheads got. If you don't have enough turnover, it doesn't matter. You're not making money. And that's where we were. This year, now that we have our turnover at a reasonable level, it's like, oh, our overheads were low all along. They only looked high because our profit was because our income coming in was so low.
Yep.
and in the meantime, because we're running away from overhead so hard, there was an opportunity I had to buy a piece of equipment that we could have, we would have had to maybe do some custom work or all the things you're not supposed to do to make the payments on it for the first couple of years. A neighboring farm, that's their mode of operation. They've been able to acquire quite a few leases and increase their scale through some custom work and some other opportunities there. Whereas we were like, oh, no, that's going to take our overheads too high. And we may have, I don't know for sure, but we may have missed out on some opportunities because we were maybe focused on the wrong thing.
Yep. And I want to be a little careful here because there are, as you know, there are lots of people who do not have an opportunity to, when they expand, it turns out they're not more profitable, right? They're doing more things for now at increasing volume and making less money. But that is the reason why we split apart the direct and the overhead costs to sort of get a quick handle on that, to say, okay, look, if we've got a sound margin, gross profit in this enterprise, then expansion makes sense, right? Because of the stepwise transformation of overheads and the generally linear change in gross profit. So it's a great point you bring up. And Eric, you and I were just involved in a deal looking through a farmer's finances where the clear answer was yes, actually spending a ton of money on this particular piece of equipment, which was obscenely expensive, provided a huge return, right? Took the business to a new level, allowed them to get more work done. Now, those are guys that like, Wally Olson, cover your ears, but those are guys that like changing hydraulic hoses and doing that kind of stuff, right? They're into that. But it's a very different business than the livestock business.
They are, but they have a key employee who likes doing it.
Yeah, that's exactly right. They've got a great employee that likes to do that.
No,
but that is a fundamental difference between the farming business and the livestock business. I think the principle is very true in both of them. It's just much more transparent in the livestock business because you literally don't need, you don't need any equipment to be in the livestock business. We need to sort of still apply that principle that I think Robbie was talking about earlier, which is let's keep those things way, way low, right? We want the money that we have spent on stuff that is going to return more money.
And I would add to that is keep your emotions out of it. If you can make it work on paper, you're much more likely to make it work in real life, and being realistic about the figures you put on paper. Know that for sure. But where we see it is we see this money roll in, we have those first good things, and that list of wants, you convince yourself is a list of needs. And, that I'll use the trucks, for example, and new trucks are always a red flag for me. You start out at the base model, but then you think, well, I want the cruise control. It's only $1,000 more. And the next thing you know, you're at $100,000 limited edition signed by, the greatest basketball player on earth in the Harley Davidson edition truck. And the $50,000 truck went to the $150,000 because it's cool and your emotion got in the way.
And I think a good tool to kind of kill emotion is the tool that me and John used helping that client buy that expensive piece of equipment. And that was net present value analysis. It is not like it is. Some people overvalue it, but it's a good place that I start with because in these people's cases, they're like, I think it's a good decision. And my gut says it's a good decision, but I just don't feel confident about the numbers. I just don't know. Okay, well, let's just start with a very simple tool, net present value analysis, and see what the numbers are. And in this case, like the numbers were between the two options were wildly different. And so that gave them confidence. We already knew that they were going to buy the what was it, a plow? What
was a drill? It was a big air seeder. You know what they are, Brent.
Was it?
Yeah.
Whatever. It was big. It was blue. It was a lot of money. And it gave them confidence that they were not making a huge elementary mistake on investing in capital. And so going back to what you were saying earlier, Brett, like how do you determine what you should purchase first and what priorities? A simple black and white tool to start your analysis. Don't end your analysis with it, but start your analysis with NPV. I'm a big fan of that.
Okay,
and I
that's
think
good to
Erica,
know, because that sounds very similar to the situation we were in. So John and I'll have to talk about that in the
Yeah.
future.
yeah, and Erica, an important point you make there is that the comparison wasn't close.
No,
And to my mind, when we looked at the comparison, you know, it's a lot like looking at Wally's 25% deal. It's like, man, the difference is that big. Like, okay, you know, even if we miss it by half, which literally is a scenario we ran, we're still way ahead with this particular scenario. So very good. All right. There were a few other things, but I think we've gone long enough. We've been it's 2:45, so let's wrap this up. If there are any final comments, Bob, Wally, or Robbie, you want to make, I am very grateful that you guys have been willing to attend today.
I've got one comment that I have been pondering, and basically I'm strictly into this business since I live on an acre right now, is that we need to separate ranching, and that's when you own a ranch and you're in the dirt and all that, from the cattle business. And you know, if you're wanting to expand, you know, you don't need to get the neighbor's place, and you don't need to get that. You can find people that will run livestock for you. Now, there's a skill set that you've got to come up with on understanding how you manage that. And but I am, you know, you can really scale a business up, and basically all you're doing is just investing in the animals, where you don't have to, you know, buy another truck. You don't have to put on another employee and stuff. Just something to think about.
No, Rick is listening carefully. Bob, you want to finish up with anything?
No, I think Wally did a good job. I think everyone did a good job. Thank you
Yep.
for having.
Awesome. Robbie, final thoughts?
Know who you are, know what you're doing, know what business you're in.
Wow.
If you don't know those things, you're gonna get confused with it. Be honest with yourself and get people around you that'll be honest. Don't fire them because they're honest with you. And the last one is get your balance sheet together every year accurately to know if you're winning or losing. That's your scorecard for your business. It don't tell you every play you made, but it tells you the end of the year score.
Boom.
Pretty good place to
I love
stop.
it. That's a great place to stop. Robbie, you're welcome anytime. Thanks for
Thank
coming.
you.
It's really been good. Glad to have you today.
Thank you for inviting me.
For all of you, obviously, we'll hang out for a couple minutes, answer if you have other questions we want to answer off camera. That's great. Wally and Bob, can't thank you guys enough for being kind enough to do this. Robbie, it's been great, excuse me, to meet you today and hear your thoughts. And I look forward to talking with all of you soon. So thank you very much.
Robbie, is Robbie in Cheyenne, or I mean in Sheridan?
Casper.
No, you're in Cheyenne, right?
Casper.
Casper. Okay.
Yep.
Very good.